Corporate Finance Presentation, Security Markets Regulation. Get ready, it's time to take your chance with corporate finance. Why regulate the security markets? When you're thinking about regulation of the markets, how much regulation you think would be appropriate? And this is an important question because the regulation does vary over time, and we have to think about how much regulation should be in place with regards to the markets. If you have a high opinion of markets, you think markets are good, you think markets are efficient, you're probably leaning towards less regulation. If you think markets are not good and not efficient or a problem, then you're probably leaning towards a lot more regulation. So on the one side, on the extreme side, you might be saying, why are we regulating this at all? The markets in and of themselves are the best determinant of price. They're not perfect, they have fluctuations, but they're the best determination factor. The regulations are going to make things worse, typically. And if you're on the other side of things, you're probably saying, well, I don't trust markets. I don't believe the markets are efficient. It causes disparities and whatnot. And therefore, we think we should have a whole lot of regulation and possibly even remove the markets at all, you might be of the opinion, and basically replace it with some kind of government distribution or something like that. Most people are usually kind of in the middle. From an economics type of standpoint, most economists tend to think that the markets are more efficient. So they tend to say the markets are going to be more efficient. And then you usually have the arguments in that some markets have problems, right? These types of problems could then be addressed possibly with the regulations. So the idea of the regulations usually being, from an economic standpoint, not to replace the market, not to say markets don't work, but to shore up what they perceive as the problems with the markets in certain areas. And there's, of course, endless debate about how much that would be and whether it's a benefit or a detriment to not having something in place. So if we want to protect against fraud, this is going to be the primary kind of component here. And you can imagine when markets do not become efficient, if you just take two individuals and say that they're going to make some kind of agreement, some kind of trade, like someone's selling a car and someone's buying a car, then obviously if there's uneven information between the two individuals, that's when you're going to result in an uneven outcome. Whereas if both individuals had all the information they needed about the car, and most likely when you're selling a car, the reason the people that sell cars or the dealerships often get a bad reputation is because they're the ones that have more information. They do this for a living, they know about the car, and if they're hiding something about the car that has a problem that the purchaser doesn't know, then you can't optimize the decision-making process. The market then, you would think, has a problem due to lack of information, lack of transparency. And the more there's a perceived lack of transparency in the market, once other people see, hey, this didn't quite work out right, the thing didn't work right, then you have less reluctance to have trade, and the whole market basically will decline. So if you can have more trust, then business usually goes better. Trust in negotiation, good for business. In the short run, of course, fraud will benefit a few individuals and at the expense of the entire market, right? And then if you can build the trust, however, then the entire market will typically benefit from that. So that's going to be really a foundational kind of component for why you would interfere with the markets. The idea of the markets is they're going to be efficient, but you want to increase the trust level. How do you increase the trust level? Usually you add more transparency. You make sure that all sides of the negotiation have the information they need to make the decision that would be optimal for them. Then you allow them to make the decision after they have the information to do so. So increased trust will make markets more competitive by being more transparent. So that's always really the goal here. The goal usually isn't to be, if you're looking at it from an economic standpoint, most economists are going to say, look, we want to make the end user the one that makes the decision, meaning we want the markets. We want two individuals to make decisions, to negotiate that decision. What we want to make sure of with the regulations is generally that all the information is out there. We're not trying to put the regulations in there so that we make other people's decisions. That's not the point. We're not trying to take the decision process away from the people in the markets to make their own decisions. What we're trying to do is make sure that the information is out there, transparent, so that each party within the decision-making process has what they need to make the decision best on their behalf and negotiate with the other parties involved to do so. So the Sarbanes-Oxley Act of 2002 also provides more protection for investors. And this is another one where basically the trust level was felt that it was declining due to the fact that there were some frauds and scandals So there was questions about whether or not what's being presented by the companies is true or actual or factual, and the regulations designed a lot of them around making sure that people can trust. And the more trust there is, then the more likely people will invest. Markets will typically grow, money will flow, and that's what we want usually. So security market regulations. Regulatory organizations include the Securities and Exchange Commission, the SEC, and the exchange self-regulating. So in other words, when you have the exchange itself, the exchange is going to allow people to exchange their stocks on their markets. That exchange in and of itself has a obligation, or has a self-interested obligation, to make sure that they have a level of trust in there. So they're going to have their own basically standards that they are going to enforce if the company wants to be trading on their exchange. So that's one level, and a lot of people would say, well, I kind of like that level because that's the self-interested people self-regulating for their own benefit. And then, of course, you have the SEC, which is kind of the external level, on the federal government level, being outside type of regulation. Then we have the laws that help govern security trading, which can include the Securities Act of 1933. We'll go into these in a little bit more detail, at least a couple of them in a little bit more detail. The Securities Exchange Act of 1934, and then there were amendments to the Securities Acts, amendments of 1975. So we'll just go over some of these laws very briefly. You can have a lot more detail on these, and you can look at the history of this. It's quite interesting to look at the history of the stock market and how these laws changed, and the types of things that were perceived to be problems, of course, in the market, which usually do come down to people committing fraud, what would now be considered fraudulent things. They weren't illegal, possibly, when they were happening, but they were not transparent. They were basically scams that were taking place. Possibly you can think of them in that way, in a larger term scale. And again, once that happens, over time, it leads to less trust in the market. And you could see some of the reactions to that with regards to regulations and whatnot, to try to build up trust in the market in order to build the confidence. So we got the Securities Act of 1933 was created to protect investors after the stock market crash of 1929. So obviously, huge crash, stock market, 1929, going into the Depression. There's a bunch of questions as to why the Depression happened, and there's endless debates on that. But part of what happened during that time, of course, is a crash. There's debate as to whether the crash itself was the thing that caused the Depression, or the Depression caused the crash, or if they're kind of things that happened, at the same time. What are the cause? And you can debate that endlessly. But as a reaction to that, there, of course, are laws that were trying to address it. So designed to create transparency in the financial statements of corporations. So note, when you're looking at the corporations, when they're issuing stocks, if you were to change the way you report your numbers, or if you have no basic understanding or basis on which you need to report your numbers, and you're trading to someone else who is not a professional, especially if it's just simply the public, then it's quite easy to deceive in some ways. You might have some people that don't have the time. It would take, in other words, if you didn't have some type of standardization for how people had to report their financial statements, the common investor generally couldn't invest, because it would take a lot more time to really dig deep into the company information and get up the information you need. So one of the things you would think you would like to happen, so that the more common person can take their money and have faith to put it into the stock market, is for the companies to have some more standardization as to how they're going to report their financial information, and so that you could do some comparisons and whatnot. And the more you can do that, the more different companies have the same standards, the more you can compare and contrast different companies, the more faith you feel about the accuracy of the reports, then the more people can basically usually enter the market. That's going to be one of the goals. Establish laws against misrepresentation and fraudulent activities in the securities markets. Securities Exchange Act of 1934, enacted to govern securities transactions on the secondary market. So remember, the primary market is going to be the stocks that are coming from the company onto the market. So the company, when they are issuing the stocks from the company themselves, they have to make sure that they're in compliance with the regulations of the law and of the exchange itself. Then you have the secondary markets, meaning stocks are already out there, one of the things that makes stocks great is that they're liquid due to the fact that you can sell them to each other after you have bought them. And so now you have to, of course, have regulation with the secondary market as they are selling stocks amongst themselves after having been already issued from the company. All companies listed on a stock exchange must follow the requirements outlined. The purpose of the requirements are to ensure an environment of fairness and investor confidence. So that's the general idea. And notice when they're talking about fairness and investor confidence with regard to the regulations, normally they're talking about things that they believe are going to make more transparency so that more information is known by the investors. And also note this is important because as we go forward, there's still going to be a bunch of questions in terms of, should we have more regulations? Should we have less regulations? Have we over-regulated? And possibly, are we reducing the standard of living by people by stifling things like trade in the stock market? Or do we need more basic regulations to go further than what we have now? Whatever the law that comes out is, whoever is supporting it will use terms that I believe are somewhat vague terms like fairness. They're going to say, well, if I do this change, it's going to make something more fair. And notice, without the details, usually you want to go into the details and say that word doesn't really tell me what do you mean by fair, because that's a catch-all phrase. Whenever you see those catch-all type of phrases, then you kind of usually want to go into more detail as to the facts or the circumstances of what it means, what the law is actually going to be doing. But in any case, overview of the law there. We have the Sarbanes-Oxley Act of 2002, which was a response to highly publicized corporate financial scandals earlier in the decade. And Enron was going to be probably the most publicized scandal that had big problems. And the other thing that was really important about it, most people know about Enron, but one of the large accounting firms, which was Arthur Andersen, also was an auditor, which it was highly thought that the auditing process should have picked up some of the problems with the financial statements. And we had separate or other kind of problems related to that as well, where it was felt that there was a problem with regards to the oversight function, the auditing function. It didn't catch things that you would think it should have caught possibly. So the process that was geared to give more transparency or trust, which was the fact that the corporations are required to have the audit, didn't seem to be functioning properly. And there was a sense that, the auditors, because they were so highly connected to the companies, possibly because, a lot of people go out of the big CPA firms directly into the large companies, and therefore there's kind of a connection in the flow of personnel from one to the other, that there wasn't enough separation between the two. And so there was more regulations that were put in place. So they made strict new rules for accountants, auditors, and corporate officers, and imposed more stringent record-keeping requirements. So we got more record-keeping requirements required, and the relationship between the audit, the idea of independence became even a bigger concept, which is always a big concept with regards to audit and accounting. But it was thought that if we separate some of the duties between the accountant and the firms, possibly have different personnel, possibly rotate the core partners that are going to be dealing with the audits of certain firms instead of having, one oversight within it. These types of laws were thought that to strengthen the audit process so that you have a stronger look of appearance and hopefully, in fact, of independence. To give confidence, once again, to people that say, hey, these financial statements that I'm looking at that were given to us, I can actually rely on them. They're not lying to me. The numbers have been reported in accordance with the standard, like a generally accepted accounting standard or whatever standard they have promised to report them in, and they actually do coincide with those standards and are accurate, and I can compare them to other companies and have faith in them. If you lose faith in the numbers on the financial statements, note, then they're just numbers on a piece of paper. They're worthless. You'd have to actually go to the company and basically do your own numbers if you don't trust the numbers that are going to be on the financial statements. So it becomes a big thing, and it only takes a couple times, as we saw here, a couple very large times, but a couple big infractions to really shake people's confidence that the things that they're looking at actually represent in a fair way, like they're supposed to, what the company says that they're going to represent. So then there's questions again on these types of reactions. Notice how reactionary these things are. Obviously, big crash 1929, the reaction in the law comes in. There's these problems that happen, the reaction is the Sarbanes-Oxley. So there's always debate as to, well, did they overreach? Did they go too far? Is this because it added a lot of cost to do some of these new regulations? Is it worth it? Is it worth the benefit? Or did we overreach? Or do we need more regulations? So that's always going to be questions that will flux. The pendulum will swing back and forth. And anytime there's a big scandal, the pendulum of law will typically swing towards a heavy hand on the law, and then possibly go back the other way at some point in time when it's seen that maybe the production and people's standard of living possibly going down, the economy's not growing as high as it could if you can let the market go. So the pendulum goes back and forth. So it also added new criminal penalties for violating securities laws. Now, this was a big problem as well, because if you work for a company, if you work for a corporation, even if you're a top management, a CEO and whatnot, you're really an agent of the company. So you have this agency kind of problem, whereas, the idea of being an agent is that, they can sue the company, but usually you can't really sue the employee of the company, even if it's the CEO or something like the top management. And so it was thought, we got to hold these top guys accountable because they're making these decisions. They're clearly benefiting from these decisions disproportionately from other people. And although they're agents of the company, how much liability should they have if they lied or committed fraud and whatnot? And what kind of penalties should be in place there? So they address some of those issues, and those are some still top concerns. What is the liability of the top management? What if the top management is dishonest? How do we deal with those kind of problems?